Hello everyone, welcome to edupediaworld.com. Today we are going to continue with chapter 3, Income Not Forming Part of Total Income, and in today's session we will be discussing about an income known as pension, how this pension income is taxed and how the amount exempted are computed. So let us start with today's class. This pension income is more or less similar to the gratuity only. Like it is, we can say that both these incomes relate to the retirement of an employee, and these are received basically after the employees get retired from their services. So these two incomes are more or less the same, but their computations, the exemptions are different. So let us study. We have studied gratuity. Now let us study pension and try to figure out the differences and the differences in computing the exemptions relating to these income. How the exemptions are calculated. We have learned how exemptions are calculated in gratuity. We'll learn how exemptions are calculated in pension also. And then we'll summarize how both these retirement income, or we can say that after service income, are computed and exempted. So let's start. Pension. So what do we mean by pension? At the time of retirement of an employee, the employer pays the employee a certain amount regularly in consideration of his past service. So as I said, this is similar to gratuity because gratuity was payment made by the employer to the employee for the long and meritorious period of service served by the employee. Likewise, pension is also there. The only difference is that gratuity is a lump sum amount paid after retirement, whereas pension is a periodic payment made by the employer to the employee. However, this pension income can also be received in a lump sum, which we'll discuss in the later part. But for now on, we know that pension is paid by the employer to the employee regularly after the retirement in consideration of his past service. This periodic payment paid by the employer to his employee is referred to as pension. So what do we mean by pension? Pension is the periodic payment made by the employer to the employee after his retirement regularly in consideration of his past services. Now, after the introduction of the National Pension Scheme, not only can the employer pay pension after retirement, but many pension schemes can also pay pension. So, this pension amount can not only be paid by the employer, but the employee can invest in some pension plan, so that pension plan will give them pension after the retirement. So during their period of service, they can invest in a pension plan which will give them pension after retirement. So they will not only receive pension from their employers, but also from this pension plan. Such investment in pension plans can also be claimed as a deduction under section 80 CCC and 80 CCD. So this pension from the pension plans are deducted or they are eligible for deduction under section 80 CCC and 80 CCD, that is chapter 6A deductions, which we will do in detail in some later stage. So this pension plan investment, the pension received from this pension plans are eligible for deduction under chapter 6A, whereas the pension received from the employer is eligible to be deducted to some extent under the head income from salaries. So this is what is pension. Now let us study the details about the provisions given under the IT Act about the exemptions related to pension income. Taxation of pension. How this pension income is taxed as per the provisions of the IT Act. The amount received as pension from the employer or from the pension fund or from any other source as pension would be liable to income tax. So, the general provision given is that any amount received as pension from the employer or from the pension fund or from any other source as pension would be liable to income tax. So this is the general provision given in the IT Act about pension, that this periodic payment will be liable to tax. But this general provision has certain exemptions and certain provisions related to it, which allows the pension income to be exempted up to certain extent and is deducted up to certain extent. So we'll study that now, that what are the various provisions attached to this general provision, that is the pension income is taxable. So before understanding the computation of tax on pension, it is important to understand that there are two types of pension. So now we'll study this in detail, and then we'll come to know that some part of pension income is taxable and some part of pension income is exempted as per the IT Act. So this general provision has certain exceptions related to it, and what are these? So before understanding these exceptions, we have to understand these two terms related to pension. What are they? Number one is uncommuted pension and number two is commuted pension. So let us see these two terms in detail, the definition of these two terms. Uncommuted pension. So what do we mean by uncommuted pension? Uncommuted pension refers to pension received periodically. So this is the normal definition of pension as we have learned in the previous slide. That is, pension is the periodic payment made by the employer to his employee at the time of his retirement for the services rendered by the employee. So uncommuted pension has a similar meaning as we have learned in the previous slide about pension. So normal pension means uncommuted pension. And we have also learned that any amount received as pension is fully taxable in the hands of both government and non-government employees. So in the previous slide also it was given that any type of pension received periodically either by the employer or the pension scheme or from any other source as pension is fully taxable. So that was about uncommuted pension. So uncommuted pension, that is pension received periodically from the employer by the employee at the time of retirement, is fully taxable in the hands of both government and non-government employees. So the government and non-government employees are not different in case of uncommuted pension, and both are liable to pay income tax on this amount of income received periodically at the time of retirement. Now comes the main part, that is commuted pension. This is something different. Different in what sense? Let us see. Commuted means interchange, meaning we interchange the periodical payment into something different. And what is that? Many employers allow the employee to forego a portion of the pension and receive a lump sum amount by surrendering a portion of the pension. So this is what we mean by commuted, and this is what we mean by interchange. We interchange some part of a portion of the pension by a lump sum amount, meaning we receive a lump sum amount from our employee and we forego some part of the pension. Such amount received is known as commuted pension. So let us see one example to understand what we are trying to say here. What is commuted pension? The pension may be fully or partly commuted. Obviously, if we are not commuting 100% of our pension, we are obviously commuting less than 100%. So that will be known as partly commuted pension. If we are commuting 100%, then that will be known as fully commuted pension. So let us see this example. For example, suppose a person is entitled to receive a pension of rupees 2000 per month for the rest of his life. There is an employee and he is entitled to receive 2000 per month for the rest of his life after his retirement. Now, he may commute 1/4, that is 25% of this amount, and get a lump sum of rupees 30,000. He agreed with his employer that he wants to commute 25% of this amount of pension which he will be receiving for the rest of his life for a lump sum amount, and the employer agrees to pay him 30,000 for that. So after commutation, his pension will now be the balance 75% of rupees 2,000 per month, that is rupees 1,500 per month. So now as he has commuted 25% of his pension amount, so now he'll only be entitled to receive 75% of the pension. And what is the 75% of rupees 2,000? That is 1,500. So he'll receive a lump sum of 30,000 at one time, and after that only 75% of rupees 2,000, that is 1,500, will be paid to him per month for the rest of his life. So this is what is known as commutation. We'll see more examples in the later slides so that this concept becomes more clear. That is what is commuted pension. Now let us see this chart to understand how commuted pension is taxed, that is how income tax is charged on commuted pension. We already know that uncommuted pension is fully taxable in both government employees and non-government employees. But commuted pension has something different from uncommuted pension. The provisions for commuted pension are different for both government employees and non-government employees. So let us see this presentation to understand what are the provisions for income tax on commuted pension. It is given over here that government employees, in case of government employees, the commuted pension is fully exempt from income tax. So, if I am a government employee, I am not liable to pay any tax on the commuted pension which I am receiving. So, commuted pension is fully exempt in case of government employees. Now, non-government employees, that is other employees. So, in this case, the employees are further subdivided into two categories. Number one is employees who are receiving gratuity, and number two is employees who are not receiving gratuity. So we divide the employees, that is non-government employees, into these two categories to further find out the taxation provision on commuted pension. So if I am a non-government employee who is receiving gratuity, then what will be the exemption of my commuted pension? The exemption will be 1/3 of full value of pension which he would have received had he commuted 100% of his pension. So my exemption will be 1/3 of the full value of pension which I would have received had I commuted 100% of my pension. This sentence seems a little bit complicated here, but as we proceed and see some examples and illustrations relating to this, you will be able to understand this in a more better way. For now on, you need to remember that if I am a non-government employee who is receiving gratuity, then the amount of exemption in case of commuted pension will be 1/3 of the full value of pension which I would have received had I commuted 100% of my pension. And if I am a non-government employee who is not receiving any gratuity, then my exemption will be half of the full value of pension which I would have received had I commuted 100% of my pension. So these are the provisions for income tax on commuted pension. Let us see some examples to understand these provisions in a more better way. Let us take this illustration in order to understand what the previous chart wanted to convey in terms of commuted pension, income tax on commuted pension. This example will make you understand those provisions about exemptions of commuted pension in a more better way. Let us start. Mr. Sagar retired on 1st of October 2014 receiving 5,000 per month as pension. So he was to receive rupees 5,000 per month as pension at the time of his retirement. On 1st of February 2015, he commuted 60% of his pension and received 3 lakh as commuted pension. So on 1st February, he decided to commute 60% of his pension and received 3 lakh as commuted pension, that is a lump sum amount of 3 lakh as commuted pension. Now, you are required to compute his taxable pension assuming that number 1, he is a government employee. Number 2, he is a non-government employee receiving gratuity of rupees 5 lakh at the time of retirement. And number 3, he is a non-government employee and is in receipt of no gratuity at the time of retirement. So, you have to calculate the taxable pension in all the given 3 cases, that is government employee, non-government employee receiving gratuity, or non-government employee not receiving gratuity. So let us see one by one all these 3 cases. What is the taxable pension in all these cases? Now let us see the first case, that is when he is a government employee. We all know that the uncommuted pension is fully taxable whether the employee is government or non-government. So first of all, we calculate the uncommuted pension. He retired on 1st of October and he commuted his pension on 1st of February. So for October, November, December and January, he received the total pension, and from February onwards, he received the pension after commutation. So for October, November, December and January, that is for 4 months, he will receive the full amount of pension, that is 5,000. So that will be 20,000. 5,000 into 4, that is 20,000. And for March, because the year ends on 31st of March, so for the month of March and February also, because he commuted his pension on 1st of February, so obviously the full month of February will also be included. So for 2 months he will receive pension after deduction of the commuted part. He commuted 60% of his pension, so now he will receive only 40% of uncommuted pension, because since he commuted 60%, now he is eligible to receive only 40% of the uncommuted pension. So that will be 40% of 5,000, that is 2,000 into 2 months, that is 4,000. So the total uncommuted pension from the period of October to March which he is eligible to receive is 20,000 for 4 months, that is October, November, December and January, and for February and March the deducted pension, because he commuted 60% of his pension on 1st of February. So for February and March he'll receive the deducted amount, that is only 40% of 5,000, as he commuted 60% of his pension. So that is equal to 40% of 5,000 into 2 months is equals to 4,000. So 20,000 plus 4,000 is equals to 24,000. So Mr. Sagar, if he is a government employee, his total uncommuted pension will be 24,000 and he will be liable to pay tax on this full 24,000, because uncommuted pension is fully taxable whether an employee is government or non-government. Okay, so this is how uncommuted pension is calculated. Now we come to commuted pension. It was given that he commuted 60% of his pension and received a lump sum amount of rupees 3 lakh. So commuted pension received by him is rupees 3 lakh. Now in case of commuted pension, it was given in the chart that we studied that if an employee is a government employee, then the commuted pension received by him is fully exempt from tax under section 10(10)(a). So this amount of commuted pension received by Mr. Sagar will be fully exempt under section 10 subsection 10(a). So this full 3 lakh will be exempted. So the tax on commuted pension will be nil. So only the uncommuted pension received by Mr. Sagar will be taxable. So the total amount of taxable pension will be equal to the uncommuted pension received, that is equal to rupees 24,000. So this is how the pension income is calculated. It is divided into uncommuted and commuted, and then the taxation on that is applied. Now let us see the second case, when he is a non-government employee who is receiving gratuity. Now the second case, that is when he is a non-government employee receiving gratuity of rupees 5 lakh at the time of retirement. So what will be the taxable pension in this case? The uncommuted pension is taxable in all the cases. So here also it will be taxable, because the uncommuted pension is fully taxable irrespective of the fact whether he is a government employee or the non-government employee. So here also, as we computed in the previous subpart, the 24,000 rupees of uncommuted pension will be charged to income tax. Now comes the difference. In the previous case, the total commuted pension received by the employee was exempted since he was a government employee. But now in this case, he is a non-government employee in receipt of gratuity. So in this case, the provision for taxation is that the amount of exemption will be 1/3 of the total amount of commuted pension had I commuted my total pension. Here I have commuted only 60% of my pension and received rupees 3 lakh in return for that, in exchange for that. So it means that rupees 3 lakh is equivalent to 60% of the total commuted pension. So we have to calculate the value of total commuted pension had I commuted 100% of my pension. So that can be calculated by dividing 3 lakh and 60%. If we divide 3 lakh by 60%, we get the full value of commuted pension, and that is equal to rupees 5 lakh. So 5 lakh is the total value of commuted pension had I commuted 100% of my pension. Though I have commuted only 60% of my pension, but what will be the 100% value of commuted pension had I commuted my total pension? So that is equal to 3 lakh divided by 60% is equals to rupees 5 lakh. So 5 lakh is the total commuted pension had I commuted 100% of my pension. And what is the exemption part? Exemption is 1/3 of the 100% of commuted pension. So 1/3 of rupees 5 lakhs comes to 1,66,667. So this is the exemption granted in case of non-government employees in receipt of gratuity. Understood how this calculation is done? 1/3 of the full value of pension had I commuted 100% of my pension. So 1/3 of the full value of commuted pension, not just 3 lakh, because that 3 lakh is only 60% of my commuted pension, and I have to get 100% of my commuted pension in order to calculate 1/3 of the 100% of commuted pension. So how that 100% will be calculated? 3 lakh divided by 60%. So we get the 100% value of commuted pension had I commuted my total pension. So that we get as 5 lakh. We divide it by 3, that is we multiply it by 1/3 to get the exemption granted in case of non-government employees non-government employees in receipt of gratuity. So this is how the exemption is calculated. What is the exemption? 1/3 of 100% of the commuted pension had I commuted my total pension. So 1/3 of 3 lakh divided by 60%, that is rupees 5 lakh, that is equals to 1,66,667. So this part is exempted from the commuted pension received. And what was the commuted pension received? 3 lakh rupees. So 3 lakh minus 166,667 comes to 133,333. So this is taxable. So the total taxable pension is equals to 24,000, that is uncommuted pension, plus 133,333, that is the taxable commuted pension after the exemption granted. So these two figures are added up to get the total taxable pension, which equals to 157,333. So understood how this exemption is calculated? The exemption is, just remember, this is the important part. The exemption is 1 by 3 of the 100% of the commuted pension had I commuted my total pension. So I have to calculate 1 by 3 of the 100% of the commuted pension and not just the commuted pension which I have received. So this is the major catch point here, which you have to remember. You don't have to calculate 1 by 3 of the commuted pension. Many students can do this. They can just multiply 1 by 3 into 3 lakh. That is the commuted pension received. But that is wrong, because 3 lakh is only 60% of the commuted pension. And the exemption condition is 1 by 3 of the 100% of the commuted pension had I commuted my total pension. So this is the major point here. You have to remember this. 1 by 3 of the 100% of the commuted pension if I would have commuted my total pension. So this is the second case. Now we come to the third case, in which the employee is not in receipt of gratuity. Non-government employee not in receipt of gratuity. Now we come to the final case, that is when he is a non-government employee and is not in receipt of gratuity at the time of retirement. The uncommuted pension part received is the same and remains the same in all the three cases, because it is fully taxable in case of all the employees, whether government or non-government. So this 24,000 remains the same, that is 5,000 for 4 months from October, November, December and January, and 5,000 into 40%, that is 2,000 for 2 months, because he commuted 60% of his pension on 1st of February. So now he'll receive only 40% of the pension, that is the uncommuted pension will now become only 40%. So 40% of rupees 5,000, that is 2,000 for 2 months, February and March, that is 4,000. So 20,000 plus 4,000 is equals to 24,000 is the uncommuted pension received, which will be fully taxable. Now we come to the commuted pension part. He received commuted pension of rupees 3 lakh. He commuted 60% and 60% was equivalent to rupees 3 lakh. Now the exemption part. What part is exempted? It was given in the chart that 1 by 2 of the full value of pension received by him had he commuted 100% of his pension. So in the previous case it was 1 by 3, that is when the employee was receiving gratuity, he was entitled to a lesser amount of exemption. But in case of employee who is not receiving gratuity, he is eligible for a higher amount of exemption. So the formula is same, just the employees who, non-government employees who are receiving gratuity are eligible for a lower percentage of exemption, and the employees who are not receiving gratuity are eligible for a higher amount of exemption. So in the previous case, the exemption was 1 by 3rd of the full value of pension if he would have commuted 100% of his pension, and in this case the exemption is half, that is 1 by 2 of the full value of pension had he commuted his 100% of his pension. So the exemption will be 1 by 2 into 3 lakh divided by 60%. So when we divide 3 lakh by 60%, we get the value of 100% commuted pension. Since he commuted 60% and got 3 lakh, so from this data we can calculate how much he would have received had he commuted 100% of his pension. So when we divide 3 lakh by 60%, we get the 100% value of the commuted pension. and when we multiply this amount by 1 by 2, we get our exemption, that is 2,50,000. Because the full value, that is the 100% value of the commuted pension is 5 lakh, so the exemption will be half of 5 lakh, that is 2,50,000. So 3 lakh less exemption under section 10 subsection 10A, that is 2,50,000. The remaining is only 50,000. So the part of the commuted pension that is taxable is only 50,000 and the uncommuted pension taxable is 24,000. When we add up the two, we get 74,000. So the total taxable pension in case of non-government employees who are not receiving any gratuity at the time of retirement is 74,000. So this is how the calculations are done. Hope you understood how the exemption in case of commuted pension in case of non-government employees are done. These calculations, that is 100% of the commuted pension. The main catch point, the main trick here is only that, and all other things are very, very simple. You just have to remember that the exemption is 1 by 3 or 1 by 2 as the case may be of the full value of pension had he computed the total amount of pension, the 100% of pension. So that is the main thing here, and all of the calculations are very, very simple. You just have to remember that the 1 by 2 or 1 by 3 is of the full value of pension if he would have commuted 100% of his pension. That is the main thing here. So this is how the problem will be solved. All the problems relating to pension will be solved in this way only. In the next slide, we will summarize what we have learned in this class of pension. After doing this problem covering all the 3 types of employees who are receiving commuted as well as uncommuted pension, now let us summarize that problem into this table so that it is easier to remember things. Now this table, we have divided employees into government employees and non-government employees, and we have divided pension into uncommuted pension and commuted pension. So in case of government employees and non-government employees, uncommuted pension is fully taxable, whether he is government employee or a non-government employee, or whether receiving gratuity or not receiving gratuity. The uncommuted pension will be fully taxable. So we don't have to think much before taxing the uncommuted pension because there are no conditions attached to it. It is fully taxable. Now comes the commuted pension, where the complications start. Not complications actually, but a few conditions, because uncommuted pension does not contain any conditions. It is simply taxable, but commuted pension contains certain conditions because it is exempted up to certain part. In case of government employees, it is fully exempt. In case of non-government employees who are receiving gratuity, 1/3 of the full value of pension which he would have received had he commuted 100% of his pension is exempt. And in case of non-government employees who are not in receipt of gratuity, 1 by 2, that is half of full value of pension which he would have received had he commuted 100% of his pension is exempt. I hope you all have understood till now what do we mean by full value of pension which he would have received had he commuted 100% of his pension. So once you have understood this, you just have to apply 1 by 3 in case of non-government employees who are receiving gratuity and 1 by 2 in case of non-government employees who are not receiving gratuity. So that 1 by 3 and 1 by 2 respectively will be exempted, and the remaining part of commuted pension received will be taxable. So this is how the pension income is described and given in the IT Act and how it is taxed. Thank you, students. Now we are done with one more income not forming part of the total income, that is pension. In the next class, we'll be doing some more incomes which do not form part of the total income. Thank you.